Okay, on today's show, 3 questions. Number 1, are the economy and the stock market speaking the same language? Number 2, who do you trust with your money? And number 3, what is the first mistake you'll make out of dental school? And of course, we'll finish with a case study. Let's go. Welcome to Dentist Money's 2 cents, where we help dentists navigate all the noise. I'm Matt.
I'm Victoria.
And I'm Rabih.
Guys, 2 weeks in a row. 2 weeks in a row. This is amazing. Dream team.
It is a blessing for the people. We know.
Giving the people what they want.
Giving the people what they want.
What they want.
The best trio.
Yes. I'm extra happy. We are getting into that stage in Utah, or just the season. I mean, not just in Utah. We just happen to live in Utah, but we are in the season of coming out of winter, starting to feel a little bit like spring. You know, March is around the corner.
Now that you say that, it's going to be gloomy again.
I know.
It's like the first sunny day in like a week, Matt, and now you're like, it's springtime.
No, it's just feeling like spring. You know, it's different. So, for example, when it snows this time of year, at least lately, it doesn't stick anymore. My snowblower's not coming out. Like, even though it still might snow, because it's getting warmer, it's not. It's feeling more like spring. You know, it's later. It's lighter later. You know, I'm no longer going home in the dark. Like it's not feeling like winter anymore, and I love it.
Matt, I'm wondering if this is a little bit of recency bias since you mention El Salvador every other sentence.
I didn't. First of all, I did not you brought it up, not me. You just brought it up. I guess on that note, we're going to move forward. I was making fun of myself yesterday, as I often do, like making fun of myself, that I sound like those people who just went to Europe and sound all cultured and that's all they can talk about. And I'm like, well, yeah, in El Salvador.
In El Salvador?
When I was on the beach in El Salvador.
Yeah, when it was
I didn't even bring
sunny,
it up this time. It was 90 degrees and sunny the whole time. So I will say this. I left El Salvador in the morning. It was 90 degrees when I left. When I got off the plane in Salt Lake, because we got home really late, it was 20 degrees. That is by far my personal record for biggest disparity in the same day of temperature. 70 degrees. It was pretty crazy. It was pretty shocking. I digress. Okay, let's jump in. Number 1, Rabih, are the economy and the stock market speaking the same language? Talk to us.
What do you guys think? Do they speak the same language?
I think at third. So I'd say yes right now. Yeah. I'd say yes. I would add a third kind of category I'd put here that's not speaking the same language and hasn't been and maybe never does is sentiment.
Yes.
That's kind of the third factor here. But I think the economy and stock market are kind of, at least in the US, I feel like they're pretty much in lockstep, but maybe I'm wrong.
They're pretty much in lockstep, except this week. Because we've got economic news that I'm going to be sharing with you, but we've also got earnings, market-related news that I'm going to share with you, and they look like completely going in opposite directions, but it's only for the week, and this is how we got here. So last week I was talking about how we got stuck on like the 5,060 level, where that was the all-time high for the S&P, and we haven't moved from there yet. Well, I'm happy to announce, thanks to me, of course, the S&P 500 is now at an all-time high.
Yes, it's all because of Rabih. You're welcome.
Thank you, Rabih.
Thank you, Rabih.
No, it's
You're
not
so nice.
Thanks, Dad.
Thanks for doing that for us.
Oh, you guys, anytime. But it's not because of me. It's because of the earnings NVIDIA posted this morning. Actually, last night, early this morning. So NVIDIA just wowed Wall Street, according to the articles, in how good the earnings have been. Growth over like 700% in earnings, over 300% in revenue. And they are kind of making annual revenue in a period of a quarter, which is mind-blowing from like fundamentals perspective.
And all driven by AI, is that right, Rabih?
All driven by AI, but it's not just like hype. It's actual other companies. It's a gold rush, and other companies are rushing to NVIDIA to buy the shovels, and this is what's happening. So yeah, even fundamentally speaking, the rise in the earnings just dropped the PE ratio to NVIDIA back to like common sense. So the PE ratio in an analogy speaking terms, we thought that it just went out of whack and the valuations are so overpriced. It can be interpreted now as it was the proper leading indicator for proper earnings coming forward. So Nvidia is up like 15% just today off the news.
Did you say 50?
15,
15.
1-5.
Oh, okay. I was like, that is outlandish.
Yeah.
15
I know
is
it's
even crazy.
outlandish. 15% just today, but
That's
year
crazy.
to date, it's up 61%.
Whoa.
Year to date.
Wow.
This has
Thanks for the tip last year, Rabih.
Anytime.
Diversification, yeah, right. Come on.
This year, year to date, the S&P 500 is about 6.71%, which is all, in line with how a stock market should behave when the Fed is saying, I'm going to cut rates.
Boring.
I'm going to cut rates. Which put the S&P 500 at a new all-time high as of today. Today, the markets are up around 1.9%, around 2%, depending on the index you're looking at. And this is the highest one-day jump we've had like in a year. So it's kind of a day to highlight in the markets. However, yesterday...
I hate the however. I hate the buts.
However...
The but.
Has a ring to it. However, last... what day is it today? I lost track of time. Actually, also yesterday, the Federal Reserve issued their meeting minutes from their January meeting. And I went through it and I highlighted a couple of paragraphs about what the Fed is looking at. And they are all stuff we kind of touched upon in previous episodes, which is a validation that we're like tracking the good stuff, the right stuff in the market. But here's what the Fed thinks about certain aspects of the economy and how they are affected by the change in interest rate regime that we've seen over the last couple of months. So remember when we talked about student loans and credit cards and auto loans?
I do, for sure. Don't I ever? One of my favorite episodes.
The Fed said that, and I quote, delinquency rates on conventional mortgages remained low, while delinquency rates on credit cards and auto loans rose in the third quarter to levels notably above those just before the pandemic. The credit quality of financial firms borrowing in the corporate bond and leveraged loan markets remained sound overall. So that we were looking at data and we're saying, yeah, people are not paying enough on their credit card loans and auto loans, but it made it all the way to the meeting minutes at the Fed. Those guys are talking about it in their meeting. So we said maybe the risk was 3/10. And now we take it to like 3.5/10.
Because, creeping up.
Yeah, because decision makers are actually considering this and it's on their radar. The second one is related to housing prices, whether it was residential or commercial real estate. And we also talked about it on previous episode. And I quote, house prices increased to the upper end of their historical range relative to rents and treasury yields, though underwriting standards remained restrictive. Commercial real estate prices continued to decline, especially in multifamily and office sectors, and low levels of transactions in the office sector likely indicated that prices had not yet fully reflected the sector's weaker fundamentals. Vulnerabilities associated with business and household debt were characterized as moderate. So, from that whole sentence, they're just saying that what we've seen in the last couple of weeks with like the New York Community Bank dropping by over 60% over one day just because on their assets, on their balance sheet, in their assets, they had a commercial real estate portion that was doing very poorly. What the Federal Reserve is saying is that on top of those losses that are going to trickle down into the banking sector, the fact that transactions in the commercial real estate sector are very low, they are not really reflecting proper fundamentals in their prices. And we think that the commercial real estate market is hurt more than what's already been priced in. So also an increase
they're
in
saying
risk.
we all know it's bad, but they're saying it's even worse than we think.
They think what we've seen already is not the whole picture, simply because there hasn't been transactions to show us the full I don't know how to say it, like the full impact of it.
The full magnitude, yeah.
The full magnitude of it.
Which makes sense, and tell me if I'm thinking about this incorrectly, Rabih, but it would make sense that there's even a delay in true understanding of how bad it could be because of the nature of real estate and commercial real estate, right? Meaning there's a delay in the sense of these loans or leases are take time to re-up or take time to a place like the transaction points of these things are so delayed, right? You have a 5-year lease, 10-year lease, whatever, 15-year lease, and these loans as well. So we might still be seeing issues from this even years from now that we're not even fully aware of yet. I'm just thinking of even personal examples. I have a client in the Bay Area who's got 2 locations. He's already shut down one of them because of various reasons, and he's leasing that space still. Well, that's up this summer. He's not re-upping that lease, so he's currently paying for it. So he's a dime a dozen, I'm sure, of how many times that's happening in these areas, and we're probably going to start seeing it more and more to this point, right, where the data is just delayed and actually coming through.
Yep. And if we all agree that the commercial real estate situation right now is in a bubble, so it either has to pop or deflate. And the pop versus deflate argument is going to depend on how many transactions happen at the same time to reflect that information. So if transactions all happen in the next month and every company is now writing down the value of their real estate properties, banks who loaned real estate developers money start writing off losses on the loans that they've put. If it all happens at the same time, this is more of like a bubble bursting. But if every couple of months we've got one commercial real estate company liquidating its assets, one bank writing off some of its loans and mortgages due to like high vacancy rates and the client is not being able to pay back, you would see it as a bubble deflating, and every once in a while you'll have like a one-off thing, just like what happened with the New York Community Bank.
It seems likely. Tell me if, again, I'm totally speculating here, but it seems logical that it would be more of a deflating as opposed to a bubble bursting. Is that, I mean,
yeah, I don't know. But most of the arguments that I've been reading about is that it's going to really depend on how quickly the Federal Reserve lowers interest rates. Yeah. If the Federal Reserve decides to prolong this and like leave it a year and reset expectations every once in a while, from a liquidity standard perspective and like transaction perspective, some commercial real estate developers will find themselves in a liquidity crunch, and they would prompt them to default in their loans because it's harder for them to source money elsewhere. The relationship for why interest rates staying where they are right now might actually speed up the trauma the commercial real estate sector is facing is not because it is because it's harder for them to find other sources of revenue or of money to like create funding.
Because cost of capital is up. Yeah.
Exactly. So they know they have outstanding loans. I'm talking about commercial real estate developers and businesses. They know that they have outstanding loans that they have to pay back. If the Federal Reserve keeps interest rates high at the moment, it's going to be very hard for them to borrow money from someone else to cover them. And it would make it, they'll have to actually depend on the business to give them the rent to pay back.
Who wants to do that?
Yeah. So would you rather just go to the bank and get money and pay back your loan and avoid a default, or just wait for business to, get stronger again, use that incoming cash flow to pay down your loans? What they are saying is that if the Federal Reserve, there's a mismatch in the timing between when the Federal Reserve cut rates and when those commercial real estate developers fulfill their loan obligations, that mismatch might transition it more from a deflation to a bursting.
So I guess, sorry, Rabih, I could nerd out on this with you all day long, but we have to move on to other topics. However, I guess my question is, if you add on top of this, the report I saw relatively recent, like within the last couple of days, and I don't have it off the top, I don't have it in front of me, but basically some worries around Japan and Europe specifically, them being nearing or if not already in recessions with lack of GDP or their GDP growth. So if we're seeing weakness, everything you're talking about with the commercial real estate that we're talking about, and then weakness internationally outside the US, why would the Fed delay any longer? And I guess I'll answer my own question as speculation. Is it just inflation? Is that the biggest thing? They're just worried about runaway inflation?
Actually, this is a perfect segue to the next note in that document I was reading, because all they are saying that the upside risk to inflation that they see right now is still higher than the downwards risk of economic activity going forward.
Got
And
it.
to read you exactly what they said, some participants, I'm quoting, some participants noted that the risk. Some participants noted the risk that progress towards price stability, aka getting inflation under control, could stall, particularly if aggregate demand strengthened or supply side healing slowed more than expected. So, what they are saying is that what would stall our fight against inflation is if demand continued to be strong, or if supply chain issues that we've been facing, they've been like resolving the last year. This is why 2023 was great. Actually slowed down. If they do that, the aggregate supply demand equation will not converge toward the equilibrium that they are looking for quickly enough, which requires their intervention. And by their intervention means that keeping monetary policy in this restrictive territory that it is in. So it is a very hard web of trying to balance whatever is happening. So it's going to be a decision to the Federal Reserve as a trade-off between am I willing to see an industry or two in the U.S. economy take a big hit and avoid an aggregate level inflation happening across the whole economy, or how do I balance them? But my intuition would go to like what the Federal Reserve dual mandate is. Their dual mandate is price stability and full employment. So if one industry took a really big hit and this did not actually affect unemployment rate, they wouldn't care. This is what I would think they would do. But we've seen the Federal Reserve intervene beyond its dual mandate before, whether it was in 2008 or in
2020.
In 2020, they just start printing money. They do more than what their dual mandate tells them to.
Yeah.
So we'll see.
Yeah. Man, I could go on. We could keep talking about this for another hour. I love this. That's great, Rabih. I'm sure continue this conversation next week. Anything else, Victoria or Rabih, on any of that? Okay, love it. Number 2, who do you trust with your money? We'll start with that. Victoria, Rabih, who are you trusting with your money?
Rabih.
Me, myself,
I was just going to say. I trust Rabih with my life and my money.
Immediately.
Yes. That's actually true. I trust all of my money with Rabih. That is very true.
Yeah, our money is trusted dentist advisors.
Yeah,
not exactly. Just me, it's the whole team.
Yeah, it's the whole team. But basically, Rabih. We could all go away and we'd still be fine if Rabih were here.
Yep.
Okay, so this came, and I'm going to give a shout out to the one and only Victoria here, who actually brought this to me. This is from Empower, correct, Victoria, from the company Empower. So there's a survey done around who people get advice from. And I don't know the details of this, Victoria, of like how many, I think multiple thousands of people they surveyed.
Yep.
Right.
Yep.
Okay. So, and it was, again, just where do you get your financial advice? And there was several here. I was surprised. I wasn't surprised by the top part. I was surprised by the bottom of this list. So I guess we'll just
work our way down.
Let's work our way down the list. So 76% of participants said they get their regular advice from their spouse or partner.
Yeah.
What are your, I guess, and then I guess we'll do this because the top 2 categories are basically the same thing, sort of. It's partner and spouse, 76%. Another 37% said family.
Yeah.
What are your guys' thoughts on that, I guess, if any?
I feel like it makes a lot of sense because money is so personal and intimate, and people tend to be pretty like siloed with it, or I don't know, in their heads, or they don't want to talk about it. Money's taboo. So who do you feel most comfortable with? Probably your partner and your family. So that makes sense to me. The dangers are.
I was just going to say, what's the danger here?
Yes. So I don't judge people. That makes sense to me. But the dangers are, is your partner, spouse, family member a CFP? Are they a financial professional? Have they done the research? Do they live, breathe this stuff all day long? Probably not. So that's kind of the obvious danger there.
Totally. I would say as well, and it doesn't tell us this, but when I see that 76% of people say their source of advice is their spouse or partner, I think that's a broad spectrum of saying on one end of the spectrum, we have healthy conversations around money and we talk on a regular basis and like we make decisions together. And then the other end of that spectrum is one of the spouses or partners just being like, oh yeah, they do it all. And I stay out of it. Right. And I think, so that's where that's the danger to me is what does it mean when we talk about you're getting your advice from a spouse or partner? I would say more times than not, I would guess just anecdotally based on my experience that it's more the latter, meaning more people would say, oh, my spouse and partner just take care of this. Yeah. And to me, I think that's a problem. That's pretty dangerous in my opinion.
Yeah, now that you mention it, there's other studies that come to mind. There's, I think more people know of like celebrities' net worth than their spouse's net worth or something like that. Like you'd be surprised. There's a good chunk of people that just also don't really know what their spouse makes or what they're worth.
Oh, totally. I think that's absolutely true. We see this with clients all the time where you could talk to a lot of our clients or just dentists in general that we talk to, that the one spouse, the non kind of dentist spouse doesn't know anything, or it's flipped. I actually have seen this a lot where the dentist doesn't know because their spouse is running everything.
Practice.
Yeah. So I think that's totally true. There's I use the term famous very loosely because
you refer to yourself as famous.
What is this? What are we talking? This is just roast Matt day. First of all, I've never called myself famous ever.
You call yourself a sad celebrity.
That is Ryan's term. And I was like, that's kind of funny. Yeah, you did. That's Ryan's term. Anyway, after I'm getting roasted by Victoria, shots are being fired. I'm just sitting over here enjoying the sunshine. I don't even know where I was going with it. Oh, no. So the reason I say famous is used loosely is because it's only to us nerds. But there's a pretty famous study that's come out recently around talking, to your point, Victoria, about talking about money. That there's been studies done, I can't remember the university that did it, that you're more likely, what they did, took people and they put them basically on a park bench and they started talking to strangers. And it came out that you are more likely to talk to a perfect stranger about sex than you would be, or like your sex life, than you would about money.
Yeah, I saw that one.
Pretty wild. So to your point, I think that's why it doesn't shock me that these are the top two. But there are dangers with that, as we've highlighted. So we'll hit the middle ones here. So the third, I was actually pretty excited about this. Yeah, the third is a financial advisor and or professional of some kind, 36%. I actually saw another study relatively recent that was talking about the growing numbers of people who are starting to trust advisors or professionals in this space, which I think is actually really great as long as you're getting advice from a quality advisor. But I do love that. And then the next two after this were search engines. I guess Google. Okay. Google.
Yahoo.
It's pretty broad. It's a pretty broad category. 30 or 29% from search engines, and then 25% said friends. And the next one that coincides with friends is like coworkers / employer.
Is this suggesting 17%. That your coworkers are not your friends?
Yeah, that's what they separated those two, but I mean, my coworkers are my best friends. So
according to you
and my family, according to me. Oh yeah. I'm not saying it goes both ways. I'm not saying it goes both ways. They're just my friends. Please be my friends. Everyone's like, stay away from me. Again, I think I do love the idea that there's a pretty decent chunk getting it from advisors. It doesn't, the 29% from search engines, that's pretty interesting to me. You guys have any thoughts on any of those, any of that list?
I wonder, I guess it also splits out like social media from that.
The next one, it would be social media. Yep.
Yeah. So I kind of first assumed that social media was put into that, but I guess it's not. So I feel like search engines, I wonder if that's like Reddit, Twitter. I'm not really sure.
I would imagine it would be
like
Twitter
articles.
Wall Street bets. I'd imagine search engines would just be like Googling it.
Yeah, like articles, different
articles, and things like that.
That makes sense. Yeah.
So the last two are my favorite for various reasons. The second to last one is attorney.
That's
14%. I don't know who's getting financial advice from their attorney. That doesn't make any sense to me. Estate planning, if you have an estate attorney, sure, but I don't know if you'd be getting financial advice from your attorney. The last one's my favorite. 10% of people are getting financial advice from a fortune teller or psychic.
Wait, you guys don't do that?
I have not gotten any.
So in the wrong industry.
Here's what's crazy. This breaks it down further. 24% of millennials said they get advice from a fortune teller or psychic, and 17% of Gen Zers said that as well.
Yep.
That just blows my mind. But
yeah, I mean, I go to my weekly medium, and they tell me the ghosts around me and what to invest in for the week. Yeah. Actually, they told me to buy NVIDIA January 1, and now look, it's up 61%.
Look at you. Yeah.
No, that was really wild to me. I can't really imagine. Maybe I should just make that a new social media character for myself. I'll dress up as a psychic.
So, yeah, there you go.
Crystal ball and all.
Exactly. Rabih, I know you've got thoughts on this.
Actually, I have more thought. Like the psychic is a joke. Even if it's actual results, I consider it a joke. But the attorney one is what confuses me. And this is also how it's related to family, right? Because if your dad is an attorney and your mom is an engineer, they are both not qualified to give you information. And if your spouse is a doctor, also is not qualified to give you information.
What if those people are a fortune teller or a psychic?
Then yes, of course.
And an attorney.
Of course. And I feel like when it comes to money, we really lower our guard down. Like whether it's your spouse or your family, your siblings, I'm not going to go to my brother and take any car advice he gives me for face value. I wouldn't go to my mom and take any medical advice she gives me for face value. But why do we do it with money? Why is money different than advice on other stuff that we actually have a filtering system for? Yeah. This is what interests me most. Yeah.
Yeah, and it's interesting. I'm trying to think of myself, and maybe this is skewed because of the work that I'm in. But I don't go to any of I would never go to my family for financial advice. That would be the last group I'd go to, and nothing against them at all. I almost feel less likely to talk to them about it than I would a friend. I'd talk to a friend probably more before my family. Maybe that's just something more about me and my family. You know what? No, actually, let's move on.
Like, how deep are we going?
I gotta call my fortune teller later. Okay. Any other thoughts on this at all? I just thought it was interesting, these results. Some good things, some things that probably people need to be thinking about. If you're getting advice from your partner or spouse or your family, just be thinking maybe beyond that and what are those conversations like? So,
yep.
Okay, last question, and then we'll hit a case study, and then we'll move on. So, third question: what is the first mistake you'll make out of dental school? Victoria, you're going to tell us.
Perfect.
Tell the people.
Maybe what they don't want to hear, but student loans. I think that I'll just cut to the chase there.
That's the answer.
The first mistake you're likely going to make is probably around your student loans. Because, I mean, if you think about it, you get out of dental school and you're still probably, you're going to hit your residency and you're not making as much money as you will later. So kind of one of the first biggest financial decisions that you have to make is, how the heck am I going to pay my student loans off? That's kind of, you graduate and that's the first thing on your mind, right? So I was kind of curious what most graduates decide to do with that, because I did not want to base this off of just anecdotal evidence. You guys know me by now, so I have to
Scotty buddy.
I have to find proof. It's because of my imposter syndrome, but then everybody learns based off of that. So,
I like it.
So dug into this a little bit more and found that 52% of graduates will pick an aggressive monthly repayment plan. So more than half are paying more than the minimums. Does it surprise anybody? I feel like anecdotally I see this a lot.
Doesn't surprise me at all, but tell the good people why that's a mistake.
Oh, sure. So I think
for people out there thinking either A, they're the ones doing it, or B, they're like, oh, that doesn't seem that crazy, or doesn't seem like a mistake. What would your response to that be?
People who are like, oh crap, I do that.
Yeah. By the way, we get it. We're not making fun of you. We're not
No, I guess
Victoria only makes fun of me on the show, so
that's true.
we're not making
And then
fun of you.
Rabih makes fun of me, and then nobody makes fun of Rabih.
Oh no.
Just kidding. I make fun of Rabih. I guess I just roast you too. Anyways, where was I going with that? Oh, why it's a mistake. So the way I put it to people on consults is when you decide to use extra cash that you have to put towards your student loans, you're saying no to other things. And you don't realize that you are actually doing that. So you have extra cash laying around. You don't know what to do with it. These loans feel heavy. A lot of people think that's the best thing to do, right? Like you have this debt. Like I get it. That makes a lot of sense if you're talking to your partner or your spouse or your family members. Most people are going to say, be really aggressive with your loans. And then you have folks like Dave Ramsey reinforcing that narrative. So I get it. But when you're using extra cash to be aggressive with the loans, you are saying no to building liquidity. You are pushing back your goal of buying into a practice, pushing back your goal of buying a house. Because what you don't, I know this sounds kind of, it's simple, but people don't really think about it. But when you're putting extra cash towards your student loans, it's gone. Like it's done. You can't use it for anything else. So before you just decide to do that, and maybe that is the best thing for you. I'm not saying that being aggressive is 100% wrong. In some situations that can make a lot of sense, but you just want to be mindful if you're going to do that. So hence why talking to a financial advisor through all of your options and just talking through what else you could be doing with those dollars instead of being aggressive is a really important conversation, so that if you are somebody that's deciding to be aggressive with the loans, at least it was very intentional, backed by all the evidence and stuff that you need to feel good about that decision, instead of just like immediately doing it. It's not a decision you want to rush into.
Yeah, I mean, that's such a good point. I love the framing of not only what are you saying yes to with this, but what are you saying no to as a result? That's a great way to frame it.
Yep.
You alluded to something really important that we see a lot, which is default decision making. So I think this is what happens a lot is dentists are like, I don't know what else to do. So there's this loan, I'm going to take it out. I'm going to take it out. And I just think it comes from a lack of stepping back and actually reflecting on a little bit. And I'm not talking even long term. I'm not even talking 30 years. Break this down in 5-year increments, 3-year increments. What are you trying to accomplish over the next short period of time? Yep. And then start building a strategy around that. Dare I say, before even doing that, understanding your values and your purpose for your career and your life.
Bring it back.
But I just say, so I think as opposed to your point, Victoria, making this default decision, I think taking a step back, really reflecting and understanding, I love this framing of what are you saying no to? The last point I'd make on this, you just mentioned the word liquidity. This is something we hit on so much that most people look to debt as a direct correlation to their stress, meaning people, I think the higher my debt loads, the more stress I will have.
Yeah.
We would actually argue that it doesn't have much, debt is secondary to the liquidity, meaning the lower your liquidity, the higher your debt. The higher your stress. Yeah. So let's focus on building liquidity rather than being aggressive with debt.
I fully agree, because the way I view liquidity is this gives you options. Because if you don't have liquidity, you're effectively backed into a corner, right? Like if something were to happen and you need cash to support you, you're not going to be like, oh, thank goodness I was really aggressive with my debt, or at least I don't have debt anymore. It's like, great. That's not helpful right now. Yep. So I fully agree. I think people very much view it the other way, like, oh, the debt is like so heavy, but maybe it's actually because you don't have a lot of liquidity, and if something were to happen, you don't have options. And not having options, people hate that, right? You go into your fight or flight mode. So avoid that by focusing on liquidity first.
Yes, I have a strategy on this of how you can kind of find a balance here. But first, I want to hear from Rabih on any thoughts on this.
No, I loved what you guys said, and I even put it more in numbers, because you are saying like, what else can you do? And when you defer to just paying your loan, it's just because you don't know what else you can do. And the way I think of it, it's like, what's the benefit of each action? The benefit of paying your loan is saving up on the interest payments. But with that money, you can do more where the benefit in like dollar terms is bigger than the interest expenses you are saving. So whether you didn't have a practice yet, the money that's going to deployed will return you more than the interest expense. And if you already have a practice and you are going to invest more in your marketing or your patient experience, etc., you're going to get a bigger reward than the reward you're getting from this saving the interest. So I always think of it as this tank full of water, and there's the interest that's going out of it leaking, and you are gonna put new water in. And if the amount of new water coming in is bigger than the amount of water going out due to interest payments, you might be better off not paying at this moment.
Yep.
Gosh, you guys are so smart. I love hanging out with you both. I love it. It's so much fun. I love it. Okay, really quick, we'll finish with this. I think we've talked about this before on the show, and I've talked about this with so many clients and so many dentists of how to strike a balance here. If you are listening and you're like, I don't care what these idiots say, I still want to be aggressive with debt. That is okay. We are not the end all be all. But here is a way to do it. If you're going to do this, you're a fresh student, or you're coming out of school, starting your associateship or practice, whatever. You've got a load of debt. Here's what you do. Do not make extra payments. If you're going to do this, there is a better way to do this. You put that money that you'd be putting towards your extra payments and put it into, and now it's even better, put it into a high yield savings account where you're actually earning something. So 4 or 5%, whatever it is. So put those extra payments, and you can dedicate it to and say, these are my extra debt payments. It's great, but it's going into a high yield savings account. And then at some frequency, no more frequent than once a quarter. I would actually say twice a year, or even once a year. At the end of the year, you look at the balance you've created and you make a decision. And you say, okay, do I want to pay this towards my debt, or do I want to do something else with it?
Yep.
Why would you? So someone might be saying, well, what if my debt is 6% and that high yield savings account is 4%? It's a 2% difference. I'm actually losing money in interest. I would say, great. That is an insurance premium for flexibility. Yep. That's what you're paying. Like, you are literally just paying an insurance premium for maximum flexibility, and it's more than worth it because you're not accounting for whatever's going to happen in the future, including changing your mind. So I guess think of it like this. It's change your mind insurance. So at the end of the year, you can change your mind if you want. Victoria, to your point, if you're making extra payments, there is no calling up that loan servicer and saying, hey, I actually need that money back because I got this incredible opportunity to go buy into this practice. So can I have my money back? No. So please do not make extra debt payments. I think it's the worst way to do this. The best way to do this is do it in chunks, doing it via like a high yield savings account. Yep. Anything I'm missing there from you guys, or any pushback on that, or questions or thoughts?
No,
Robbie's giving me the okay. Robbie's like, when I get the sign off from Rabih, my day has been made.
You can retire.
I'm just done. I'm going to walk away now and be happy. Okay, guys, jam-packed. We've covered a lot. Hopefully that's all helpful. Victoria, hit us with the final topic here, being a case study. The final blow, the case study.
Perfect. Let's hit it. All right. I'm a practice owner out of Indiana with one location. We do about $1 million in collections, and I pay myself about $225,000. My husband and I are about 10-ish years out from retirement, but I feel so behind. I don't think we will have enough to retire by then. We really struggle with keeping our spending in check. We lived our life a certain way for a while, and it's really tough to cut down on spending. SOS, any suggestions?
SOS. Rabih, you want to go first? What are your reactions to that, if any?
Whenever there's not enough information. So when I don't have enough information, I usually defer back to a framework. And the framework is going to be, what is your assets and what are your liabilities? Your assets are going to be the value of the practice, the value of your real estate, all your investment accounts and checking accounts, etc. And your liabilities are going to be that lifestyle times the amount of years you're going to be living it. So if you're going to be retiring for 30 years, your liabilities are your spending times 30 years, right? So, and then we look at each of these. We're going to look at the liabilities, we're going to look at the assets, and fingers crossed, we hope that the assets are bigger than the liabilities. If they are, we just go into the data crunching mode where we're trying to immunize and make sure the cash flows match, right? If we are not, it's going to be a bigger conversation. And here's where like Matt will provide tons of value, because it's about like the financial planning aspect of it, and how you're actually going to get to a point where the math is working. Because if your assets are below your liabilities, it just means that there will be a pain somewhere to be had to balance that equation again.
Yeah, I totally agree with Rabih. There's just not enough information here overall. I'd want to talk to this person so badly. First of all, I can sense the stress just in the last couple of sentences there, and I feel for them. So, but I'd want to know a lot more. The first thing that jumps out to me is when I look at the numbers, just the high level numbers of $1 million in collections. First of all, congratulations. Like, that's great. You should be really proud of that. You're 7 figures in collections. But then they say, I pay myself $225. I'd want to know, this happens a lot with dentists where they say, I pay myself X. They're going off of like their W-2. I want to know, what is your actual profitability from that practice?
Ooh,
so
good point.
If you're paying yourself $225 in W-2, okay, what's your business income on top of that? And then adding back depreciation, adding back amortization, any interest expense. What is your actual net income from that practice, or what we would call profitability rate? It would hopefully be at least 400,000, if not closer to 500,000 with $1 million practice or collections. 500,000 would be super healthy. If it's not, that's where I'd start, because that's going to be the origins of all your issues moving forward. Spending being another one. If you're saying your spending's out of control, I'd want to know what that means and get more details on that. And then to Rabih's point, I'd also need to know, what do you have already saved for retirement? You say you're behind. You say you spend too much, but the devil's in the details. Because that could either be totally true if we looked at the data, or it could be actually you're in a way better spot than you think, which we've seen quite a bit. But I'd want to know how much you've actually saved for retirement up to this point, and what is the profitability of your practice.
Yeah, I agree. I think not enough details in here, but I think to summarize both of your points, it's got to come from one side or the other. You can either increase your income, like hopefully maybe look at the P&L and see how we can do that, or you have to decrease spending to make room for putting more away for retirement. So I think I agree, Matt, looking at the P&L first and diving into the details there, and then also seeing, okay, are there opportunities to decrease spending? But that's tough. It's really tough once you've lived your life a certain way, and if there's not much you can do with the practice, like, and that's your only other option is to decrease spending, that is a pretty tough exercise, and is part of the reason why we really push time and time again, knowing your core values and what's actually important to you, because mindless spending eats away so much of that. Like, if you just took the time to really dive into how you are spending and deploying your dollars, there's probably a good amount of opportunities to decrease that. So it's got to come from, either increasing income or decreasing spending.
Totally. I'd also want to know, and I know we got to be done here. I'd also want to know what retirement means to you. When you say you're 10 years from retirement, there's also a broad spectrum there.
Oh, good point.
Right? Of like, on one end saying, I'm hanging up the handpiece, I never want to see a patient ever again in my life, versus on the other end of the spectrum saying, well, we want to sell the practice, but I'm going to work, maybe I'm going to transition to something else. Maybe I'm going to teach, maybe I'm going to consult, or I'm going to just work chairside as an associate for a day and a half a week. And then everything in between. And
totally.
I'd really want to dive into that, because you may not be as far behind as you think, depending on what retirement looks like for you. And if you're, very rarely, in my opinion, do we see people just ride off into the sunset and never make another dime from their human capital ever again, especially as a highly skilled professional like a dentist. So I'd want to know more about that. I want to talk to this person. Hopefully we are talking to them soon, because I just want to dive into the details. So hopefully that's helpful. I guess last thing, they say any suggestions. I guess if we're giving them tangible suggestions, it would be you got to dive into the practice numbers. We got to understand what that real profitability number is. How much cash do we even actually have to work with? And then you say we're struggling with keeping our spending in check. What does that mean? Like we got to dive in. What are you actually tracking your spending?
Right.
So I guess the suggestion here is let's get really detailed about these numbers as opposed to just using emotions and feelings so we can start to line those things up. That would probably be my suggestion.
I agree with that.
So, okay. And then buy NVIDIA. Just kidding. Just kidding. This is not financial advice. Wow. This is not financial advice. I'm just bummed that I didn't. So, okay. Anything else, guys?
Nope.
Okay. I will finish with this. DennisMoneySummit.com.
Yes.
Do it. Listener, are you out there sitting here thinking, man, Victoria and Rabih are so cool. And I want to, and they're so smart and I want to hang out with them. Guess what? There is a way to do that. There is a way to do that. Come meet Victoria and Rabih. Shake their hand.
And you.
I mean, I'll be there too. And not only that, but get inspired by incredible speakers. There's an answer to this. June 20th through the 22nd in Park City, Utah. DennisMoneySummit.com. Check it out. It is honestly going to be incredible. We've been talking about Victoria running a money circle. That is it's women only and very limited space. So go to DennisMoneySummit.com. Check it out. We'd love to see you there. For now, everyone, that was our 2 cents. You all know what's left to do. Go forth, live your rich life. Till next time. Bye-bye.